Today's topic, navigating the home buying process as a physician. Where did this topic come from? Well, it's pretty darn common. It's actually so common that it was one of the few topics that we wrote down that we said we get the same question over and over again, whether that's from current clients, new clients, WealthKeel Weekly readers, YouTube watchers, blog readers. We continue to get the same question over and over again. So when that happens, what do? Well, we make a video about it. So today, that is what the video is about. 3 primary topics I want to cover in this video. 1, how much home can you afford, right? That's one of the most popular questions in there. How much home? We're going to cover that. We're going to give you some numbers to work with, some percentages to work with. Next up, for my physician community, what is the physician mortgage? Should you be using it? Are there other options, and what the heck does it mean? What does it do for you? And then last but not least, another major misconception is closing cost. You sometimes hear physician mortgage, you say, I heard there are no closing costs, right? You just kind of show up, you sign, and boom, here's the keys. There's a lot of moving parts to your closing cost. We're gonna walk through all of those. So 3 huge pieces of the home buying process, all coming up next, so stay tuned. First up, how much home can you afford? Probably the most common question and the most exciting topic for many. The first headline we use here is 28%. So one thing that we learned through our CFP studies, but also just the journey of life, that is the common number quoted, 28% of your gross income. Here is why I don't love that number. We have built hundreds of one-time plans. We literally have 100+ ongoing clients that we work with year in and year out. Almost none of them are anywhere close to 28%. That is a pretty high number. And I'll tell you why it's a scary number for physicians as well. Usually physicians want to buy that first home, but then the family planning process will start after that, right? We see that very commonly in the physician world. Kids have their own costs. We want to send them to private schools. So already pushing up to the high end of that budget can be a little bit scary. The other problems we have in there is something else that we track is your total debt ratio, which is a number that we always want to keep below 36%. But if your home budget's already eating up 28% of that, you have student loans, maybe you're a dual physician household, you have 2 sets of student loans, you have 2 cars all of a sudden, you have a little bit of credit card debt, or you have a personal loan that built up through your training, we are in a really tough spot where a lot of our gross income dollars are going to pay debt before they even get to the fun stuff. So the number quoted is 28%. I don't love that number. I think you should be well below that. I actually said that the average for our clients is usually a little bit closer to 14, maybe up to 18. Will some sneak up to the higher side? They will. Usually there's something in there that is a reason why, where we know maybe one of the incomes is going to jump up, right? They have that initial contract, but they're on a partnership track and we know it will go up. And even that can be a dangerous game, right? You don't want to be buying a house that you're going to grow into. I'd rather have you get a better foundation and then maybe we upgrade at a later point. So first and foremost, 28%. You're probably thinking, well, that's not any fun. Let's add some context to it. My eyes got to bounce a little bit here because I'm going to read you some numbers. What does 28% look like? All right. Remember now, this number I'm going to tell you is only principal and interest. We call this your primary mortgage payment, right? It's your principal and interest. That number is locked in for the duration of your mortgage. Let's use the term of a 30-year fixed mortgage. So in this example, you get a 30-year fixed mortgage. That payment does not change. This is another common misconception. Your principal and interest are the same. Now the numbers will fluctuate between how much is going towards principal to how much is going towards interest. Early on, you pay more towards interest. Later, you pay less towards interest, more towards principal. The number that will change on you is usually the escrow number. I shouldn't say usually, that is the only number that can change. And what is in your escrow? Well, for most people, you're going to escrow your property taxes and your homeowner's insurance. Homeowner's insurance is usually not your highest cost item. I'll actually cover this a little bit more in the video, a little bit later on. It's usually your property taxes. As those numbers change, your escrow number can go up. So one of the questions we always get early on when one of our clients will buy a new home is, how come my mortgage payment went up? We're like, well, your mortgage payment technically didn't, but your escrow is in there. And if you're sitting there thinking, what the heck is escrow? Escrow is you making part of your payment to this little bucket off to the side, your escrow, where you're putting money in there so that when your property tax bill comes due, you're not sitting there staring at a bill that says $7,000 and you say, whoops, forgot to set money aside. So it's this forced saving mechanism for your property taxes and your homeowner's insurance. So that's what escrow is. So principal and interest, that's all we're looking at for these numbers here. So what does it look like if your income is $18,000 per month? And if you're trying to say, what the heck does that even mean for me on monthly? That's about $216,000 per year, because we're using gross numbers. It makes it a little bit cleaner. That would mean that 36% of that is about $5,000 per month. If we're using the current world that we live in, I'm recording this video in August of 2023, a 30-year mortgage is right around 7%, maybe a little bit higher, maybe a little bit lower, depending on some things, but let's just call it 7%. How much home can you afford in that example? About $750,000. Now remember, that's just your principal and interest. So in this example, you need to be below that because you probably have at least 1,000, maybe a little bit more than that, depending on the size of the home, property taxes, your homeowner's insurance, where you need to keep some flexibility in there. But it's a really good indicator, right? 28% of your number, you're at $750,000 of a home at about $216,000 of income. And as I noted at the start, I still think that's too much home there. I really do. But let's keep working through some here. So if your household income is right around $450,000, we're looking at 28%. You're looking at 30-year mortgage, again, still 7%, 30-year fixed, 7%. You're looking at about $1.5 million home. Now, if you're watching this video and you're not a physician, you're probably thinking this is getting crazy. But for a lot of physicians, that's pretty common, right? Especially, maybe it's not their first home, but I would say a lot of our physicians are in academics. Academics are in larger cities, probably going to charge you more for that home. So that's at 1.5. And then if your household income is closer to about 600,000, still utilizing that 28%, we're now looking at around just shy of a $2 million home, about 1.9 and change. Again, same numbers here, 30-year, 7-year fixed. Now, with all of that said, my goal is to give you some guidelines to how much you can afford. This is very high level. I'm going to use that 28% number, but I want you to be below that. I mean, in a perfect world, if you're trying to aim closer to like 14, if you're lower than 14, fantastic. I'm very proud of you, but you want to be a little bit closer to that. One, to give you room for what I noted there on just your escrow payment, but two, especially if this is your first home as a physician, you probably still have a lot of new expenses to come up. I always use family plan as a good example, where our residents or fellows or early attendings are saying, hey, I want to go buy a $750,000 home, and it takes up 20% of that number. Fantastic. You know, it looks pretty good there. We can work with 20%. But then all of a sudden, you now get into, well, we just had our first child. We had our second child. We now have to get a nanny, right? We need to have an au pair come in. We also want to send our kids to private school to keep up with the Joneses, right? We all know that we end up doing that in a lot of circumstances, especially in that physician world, because there is a little bit more peer pressure there, or maybe you just don't have the luxury of a good public school system, which again, in certain cities, again, using academics, that's not all that uncommon, right? So that's why we like to be a little bit lower than that. But one of the main questions we get is how much home can we afford? 28% is your Google search. I want you to be lower than that, but I also want you to really work through this number, talk through this with your spouse or significant other. If you're working with a financial planning team, they should be able to guide you through this, holding your hand, hugging you the entire time. But that is your first stop on the journey to buying a home here as a physician. Next up, the physician mortgage. So you started the search, you think you got one that you really love. Now what do we do? First, you want to find a reputable, independent mortgage broker who specializes in physician mortgages. Why do I emphasize this? We have seen some weird stuff where someone was told it's a physician mortgage. And then when we start to dig through it, it certainly was not a physician mortgage. It was like this weird 2 separate mortgages where this mortgage actually then removed the down payment requirement, but then it also triggered this and then that, and it definitely was not. It was not a physician mortgage. True physician mortgages are going to cover all of that in one mortgage. So that's where you're going to start. You want to look for a reputable mortgage provider that actually understands physician mortgages. There's plenty of resources out there. We have a blog post on physician mortgages. We'll link that down below where you can also click on that and also find some good resources for yourself. So what is the physician mortgage? Well, in short, the physician mortgage is a mortgage that's available to physicians. It also includes vets and dentists. There's also other professional loans for attorneys and other professions like that, where the main benefit is because they trust your future career earnings, they make it a little bit easier for you to get access to this debt or to this loan per se. In this example, we're referring to a mortgage. Some of the big benefits to the physician mortgage, ideally, no down payment. So you don't have to come in there with a down payment. Now, does it mean you want to avoid a down payment? No, there could be a lot of reasons why you want to put money down still. So don't come into it thinking like, I don't have to put anything down. That's what they told me. You may still want to put money down. The other nice thing is, even if you're below 20%, you avoid something called PMI, private mortgage insurance, where on a more conventional mortgage, PMI is going to be in there anytime you put less than 20% down. As we tell all of our clients, you should still look at a more conventional mortgage, because some conventional mortgage these days will allow you to put as low as 3% or 5% down. Now, what's the downside on this side? Well, you're gonna have PMI. But the good thing is PMI will eventually fall off. So one of the main things that we always look for is, okay, we have our physician mortgage here, we have our conventional mortgage here. If the rate is decently lower on that conventional mortgage, and we know that PMI will eventually fall off, it could still be worth it to go that route, right? Because PMI will fall off, but there's a huge difference in a 7% and a 6.5, or a 7% and even 6.75, especially on these larger numbers, right? We're talking about a $500,000 home or 750, or even if it's in the 7-figure club. Even though physician mortgages are a fantastic tool for our physicians to utilize, you should still do some research on maybe something else making sense. Make sure you're walking through that. A good physician mortgage broker will also help you analyze that. Or if you're working with a good financial planning team, they'll also be able to analyze that and literally show you the difference on, hey, this one, because of the PMI, we pay extra over this amount of years, but in the long term, because of that lower interest rate, here's what we have. That's what you're really looking for in that analysis. So make sure you understand the pros and cons to the physician mortgage, but then also take a look at, does it make sense to maybe at least get a quote or look at what a more conventional mortgage could look like? So in this example here, again, you're looking for the physician mortgage. You want to make sure that it's checking all your boxes, but you also want to take a peek over on that more conventional side to see if there's an option there. Another thing in here is get that pre-approval letter. You're maybe in the initial stalking of Zillow and you're going through things. Maybe you've already hired a real estate agent. You want to also build a relationship with your mortgage broker sooner than later, because they're the one that's also going to give you that pre-approval letter. And my one note with pre-approval letters, they will pre-approve you for a number dramatically higher than what you should get. Do not increase your Zillow searches, right? Do not say, well, my mortgage broker said that I can get 1.5 million, but the entire time you or your spouse or your significant other were sitting there saying like, I don't know, our perfect home looks like 750, looks fantastic. Maybe we should buy more. That's what the mortgage letter said. No, don't take the bait. Remember, you're following your own guidelines. You're building your own plan here. The mortgage broker doesn't get hurt if you can't afford that home 2 years later. So not to speak badly on mortgage brokers, but they will put in anything that letter that you ask for. And even if they're just using your income requirements, it can probably give you a much higher number. As I noted to start the video, right? I still think 28% is too high. Some lenders will go the whole way up to 30%, maybe even a little bit more than that. So don't take the bait, trust your process, but that pre-approval letter is important. Keep an eye on those physician mortgages. Huge benefit to the physician community. It's an extra option you have in your pocket. Doesn't mean you have to take it, but it's an extra option that many don't have access to. So take a look at that physician mortgage and working your way through this home buying journey here. All right, time to get out that checkbook. Let's talk about the overall structure of what you can expect to pay at closing. First and foremost, we're going to cover the down payment. Now, you're probably thinking, well, I'm getting a physician mortgage. I don't have to put a down payment. No, my friend. You could still add a down payment. I would actually suggest you add a down payment. I usually tell a lot of our physicians, let's still aim for maybe 5 to 10% on a down payment. So if we're looking at a $750,000 home and you got to put 10% down, it's a big number, $75,000 in that example. But here's why I like down payments, even on physician mortgages. Number one, you're going to lower your overall monthly payment, right? Your mortgage is going to be smaller because you put a larger down payment on the home. So now you have a smaller payment. I like that. Number two, you have instant equity in the home. Assuming you didn't do any crazy things and get into a bidding war and now you're $400,000 outside of the actual price of the home, at least based on comps around the area, you should have instant equity in the home. I like that. And then number three, which is really the newest feature of rates somewhat skyrocketing. So now we're seeing 30-year rates at 7%. You now have a reason to put more money down on your home. Where if we went back just a few years ago, you could get a 30-year mortgage at 2 or 3%. In that example, at least from a risk versus opportunity perspective, you might do better off, in the stock market per se in that example. So maybe you didn't want to put as much into your home. That has changed quite a bit in the past few years. So I also like putting a larger down payment now because of those higher rates. So those are 3 reasons why I really like down payments. Now, next up is what I traditionally call your closing costs. I had to make a list. I actually had to go into our mortgage document to see what are the main things that we're looking at for here. But your closing costs can include things like your mortgage application, your underwriting, commissions, home inspections, home appraisal. That all comes into this number. Now, typically you'll see this range anywhere from 2 to 5%. We moved to Tampa from Philly, but Philly has this unique transfer tax, which is 4%. So certain areas can have higher or lower closing costs. But if we're using $75,000 and we're saying somewhere between 2 to 5%, that's anywhere from $15,000 to up to $40,000 in closing cost on a $750,000 home. So the larger your home, the higher those numbers can go up. Remember, this is not part of your down payment. Now, some physician mortgages will allow you to roll some of that into your mortgage. I could make a case that I don't really love that because now you're taking these one-time costs, putting them into a mortgage that's now spread out over 30 years and you're paying 7% on it. If you're forced to do that, life happens, I get it. But for the bulk of us, we want to pay those out of pocket, right? We want to cover those. So all of a sudden we just did, let's say we were doing 10% down. There was $75,000. Let's say we're on the high side, 5% closing costs. There's another $40,000. So now these numbers are starting to build up quicker than we would have hoped. The other two big shocks to the system here are your prepaids. Prepaids are, remember when I noted earlier in the video, escrow? Prepaids are essentially those same categories. This is your homeowner's insurance and it's your property taxes. Usually they're going to ask for a full year of homeowner's insurance. Homeowner's insurance for the bulk of us, especially on, let's say, that $750,000 home, somewhere probably between $1,000 to $2,000. Certain areas could be a little bit higher. I actually looked up what ours were. We were a little bit closer to $3,000. Now, we live in Florida. We don't have income taxes, but we do have higher property taxes. The insurance is also a little bit more expensive for us because we have those big things called hurricanes. There's also some other weird stuff that's happening in the insurance market in Florida, but we'll save that for another day. So in our example there, on the prepaids, our homeowner's insurance was a little bit more expensive than what it was, when we lived in Philadelphia. But let's just say somewhere between 1 to 2,000. I think the national average is actually just a little bit above 2,000, but it depends on a lot of factors. And then the other one that can be a little bit more painful is the prepaid on the property taxes, because that's about 6 months worth. This is one that caught us off guard, and I do this for a living, but at the same time, you don't know what the exact number is. And even when we asked our mortgage broker and the real estate agent, they couldn't give us a specific number. So we knew it was gonna be a higher number, but it's even a little bit higher than what we thought. So that's why I say it even caught us off guard. And then oddly enough, the actual property taxes have not been updated yet because of the rapid growth in Tampa. So we ended up getting a lot of that back, but now they'll start to go up again. So there's some unique things that can happen with those prepaids, but it doesn't matter. Like, we still had to pay that up front. Even though we ended up getting some of that back, that's a very unique circumstance. You won't see that in many areas. I think we've seen it in Florida, some of the faster growing areas of Texas, we've seen it. I'm sure there's other places in the country, but just keep that in mind. So you get through all of these, now you're probably thinking, okay, that wasn't so bad. We had the down payment, we had our closing costs, we have those prepaids, we're good. Well, don't forget, you now have a large home that's unfurnished. And also, how did you get to your home, right? You gotta move there. And for a lot of physicians, you're usually not moving down the street, right? You're probably moving across the country to where when your training ended to where your attending was, or maybe one attending role to your next attending role. So you gotta make sure that you're also keeping that in mind. So you're looking to keep an eye on how much is it gonna cost to furnish the home? Maybe you have some stuff already, maybe you wanna upgrade. And then the other big one in there is your moving cost. If you wanna move from Philadelphia to a Tampa or a California to a Philadelphia, a good moving company, and this is one you probably don't want to go with the lowest cost option on, it can cost $15,000 to $20,000 to load up a moving truck, have it shipped across the country, have them unloaded for you. So it's not cheap. And like I said, you don't want to pay for the low cost option because your stuff might not show up, or it may show up in a lot of pieces. So those are the other ones on there that you got to keep an eye on for your closing costs. Even though they're not technically a closing cost, it's a number you got to keep in mind because you got to get from point A to point B. It's your moving cost. And then when you get in there, you got to put blinds in the window, right? You got to put a kitchen table in there. You got to put a bed. Some of that might come with you, but if you went from renting your entire life and now you're buying your first house, you probably have more square footage that you have to cover. So part 3 of the journey is just preparing for those costs and knowing what to expect to at least have an idea when you're starting to build that true home budget. And there you have it, 3 vital things to keep in mind in your home buying journey as a physician. This was a fun one to walk through. Like I said, it's really a part of every financial plan that we build for the most part, or at least a topic that we cover quite a bit, whether that's for our ongoing clients or our one-time plan builds. But it's just one of those fun topics. It's such a monumental life event buying that home, whether it's your first home, your second home, or vacation home. So I hope this gives you some good details to run with. If you have not subscribed, now's a good time to subscribe to the channel. If you click on this little bell icon, we'll also give you a notification every time we release a new video. Thank you for walking through the home buying journey with me for the last 15 minutes or so. And as always, I'll catch you on the next video.